All right, we'll go ahead and get started this morning. Good morning. Thank you for joining us for our presentation of updates to the Employee Retention Credit and the second round of the Payroll Protection Program. As most of you probably know, vcfo is a finance and human resources consulting outfit that provides CFO, controller, and human resources services to small and medium-sized companies, as well as recruiting for finance and accounting role in human resources roles. Before I begin, I'd like to introduce myself and my colleague, Jennifer Lennarz. Jennifer is a consulting CFO out of our Austin office and is one of our internal experts on the Payroll Protection Program. Jennifer has worked with many clients over the years, providing financial and operational leadership to privately held, private equity-backed, and public organizations. My name is Chris Hysinger, and I am a consulting CFO out of the Houston office. I have provided financial and operational expertise to companies in the oil and gas, retail, automotive technology, and commodity trading sectors. Along with Jennifer, I have been following COVID-related small business assistance closely for vcfo. In today's presentation, we're going to go over some of the changes that have been made to federal relief for small businesses related to the COVID-19 pandemic. We'll summarize some of the legislation and speak specifically on two issues: the Employee Retention Credit and PPP, Payroll Protection Program, in particular, second draw loans related to that program. At the end, we're going to leave about 15 minutes for your questions and some answers. First, I'd like to talk generally about some of the changes that were implemented at the end of December in pandemic-related relief for small businesses. Most of you are probably familiar with the Families First Coronavirus Relief Act, which provided tax credits for paid leave for employees who were impacted by the pandemic. The legislation extended these tax credits on a voluntary basis through March 31st of 2021. In addition, the Employee Retention Credit has been extended and expanded. We will get into those details in a minute. Employers who elected to defer payroll taxes in 2020 now have an extension of up to 1 year to repay those deferred taxes. And other changes were made, including carryover limits for flexible spending accounts and the ability of employees to receive tax-exempt contributions from employers for student loans. The biggest change, of course, was made to the Payroll Protection Program. There was an extension of the time period over which companies could make first draw loans, and there was a creation of a second draw loan program that is available to the hardest hit companies. First, let's speak about the Employee Retention Credit. The Employee Retention Credit provides a tax credit equal to a percentage of eligible wages that is claimed against an employer's portion of the payroll tax. This credit was initially enacted in the March 2020 CARES Act legislation and is available to all employers, regardless of size, who are adversely impacted by the pandemic. In the original legislation, however, a company could not claim the Employee Retention Credit and a PPP loan at the same time. If they received a PPP loan, they are not eligible to claim the Employee Retention Credit. With the Consolidated Appropriations Act enacted in December of 2020, the Employee Retention Credit was greatly expanded. Taxpayers now have the ability to claim this credit even if they received a PPP loan, and this could positively impact many people on this call. This expanded eligibility is retroactive to March 12, 2020. So for companies that received a PPP loan in 2020, they should now review whether or not they're eligible to also claim the Employee Retention Credit. In addition, the period over which the ERC can be claimed is extended to June 30th, 2021. So wages in Q1 and Q2 of 2021 are now eligible for the credit. Final IRS guidance is still pending. There's a lot of information about how the credit worked in 2020, but the specific rules around 2021 have not yet been released. Because this act spans 2 tax years, the rules are bifurcated. There's one set of criteria that applies to 2020 and one set that applies to 2021. We'll now go through what those criteria are. So in 2020, wages that are subject to the employee retention credit include all wages paid after March 12th and before December 31st. For 2021, it includes wages paid in the first and second quarters of the year. It's important to note that wages paid with PPP funds may not also be used to claim the employee retention credit, and we'll elaborate on that in a minute. In 2020, the credit amount is 50% of qualified wages, and we'll define what qualified wages are here in a moment. And in 2021, that credit expands to 70% of qualified wages. To be eligible for the credit, a firm must be engaged in a trade or business during the time when they claim the credit, and they must have either had a total or partial suspension of operations due to a governmental order, or must have experienced a significant reduction in gross receipts. I'm going to elaborate on what those two criteria mean here in a second. For 2020, the maximum credit that a company can claim is $5,000 per employee. In 2021, the maximum credit is $7,000 per employee per quarter, or a total of $14,000 over the course of the 2 quarters. Now, to qualify for the credit, a company must either have experienced a partial or complete shutdown due to a governmental order or a significant reduction in gross receipts. The first criteria, a partial or complete shutdown, is much more subjective than the gross receipts test. It's up to the company to determine whether or not they qualify using this criteria, and it's important that they thoroughly document their rationale if they decide to claim the credit based on the partial shutdown criteria. IRS has some Q&As about what constitutes a partial shutdown, and I'll just give a couple of examples to illustrate the complexity that exists. They give, for example, a retail store that is forced to close its storefront because of a government order. However, the retail store has an online presence and a service business that is not forced to close. In fact, the service business may be considered an essential business that is exempt from governmental orders. In the IRS's view, that would still constitute a partial shutdown because the retail store was forced to close, even though other parts of the business are allowed to operate. Conversely, though, they give an example of a large retailer that has large stores, like a department store, that is forced to reduce its capacity in its store while it's operating due to a governmental order. In that case, the IRS argues that because the store is so large and the reduction in capacity doesn't effectively reduce the store's ability to operate, it would not qualify as a partial shutdown. So I think it's important for companies to gauge what impact the order has on their business when they're determining whether they meet this qualification. Of course, the best test would be the objective gross receipts test. In the gross receipts test, in 2020, the credit is available in any quarter where a company's gross receipts are less than 50% of the gross receipts in the corresponding quarter in 2019. And their qualification continues until the quarter after the gross receipts are at least 80% of the gross receipts in the corresponding quarter in 2019. So what's that mean? Let's say in the second quarter of 2020, a company has gross receipts that are 49% what they were in the second quarter of 2019. The company would then qualify to claim that credit in the second quarter of 2020. If that same company then sees gross receipts rebound to 90% in Q3 of what they were in Q3 of 2019, the company would still be able to claim the credit in Q3, but that would be the last quarter in which they'd be eligible. In the fourth quarter, they would no longer be eligible for the employee retention credit. 2021 is a much lower hurdle to reach. The credit is available in the first or second quarter where gross receipts are 80% or less than the corresponding quarter in 2019. Companies also have the option of looking at the quarter immediately preceding the quarter in 2021 that they're evaluating to determine if they meet the gross receipts test. This means that here we are sitting in the first quarter of 2021. If a company's gross receipts in the fourth quarter of 2019 are 80% or less than 80% of what they were in 2019, they would be able to claim that credit in Q1. They don't have to wait for the end of the quarter to determine if they meet the threshold. Now, the last piece of this puzzle is the qualified wages, and the qualified wages are essentially the wages over which you claim the credit. If you have 100 or fewer employees in 2021, qualified wages are all wages that the company pays. However, if you have more than 100 employees, qualified wages are only those wages paid to employees who are not performing work or services because of either the government shutdown or a reduction in business activity. For 2021, the criteria is similar, but the threshold is higher. If you have 500 or fewer employees, all wages are considered qualified wages. While for employees with more than 500 employees, only wages paid for employees who are not performing work or services count as qualified wages. So just a few points that I want to emphasize. Any wages paid with PPP funds cannot be used to claim the credit, nor can wages be claimed, any wages paid for PPP funds cannot be used to claim the credit. So there's no double dipping. You can either pay with PPP funds or claim the employee retention credit. In addition, if you claim credit under the Families First Coronavirus Relief Act, you cannot also claim those wages for the employee retention credit. If the credit is claimed relying on the partial or total suspension criteria, it's very important that you document that those decisions and the claiming of the credit is subject to audit. So you need to be prepared to provide audit support should the IRS question your claiming of the credit. Like the PPP, qualified health plan expenses can be included in qualified wages when you apply the credit to your qualified wages. And the credit is claimed against the employer's quarterly payroll tax payment. For those who are going back into 2020 to retroactively claim the credit, they can file amended 941 returns and request a refund, or they can apply any credit amount to a future quarter's payment. With that, I'll now turn it over to Jennifer, who will talk about the second round of the Payroll Protection Program.
Thank you, Chris, and welcome everybody. So the Economic Aid Act for hard-hit businesses, which I'm sure it's got a long name, I've shortened it just to Economic Aid Act, or EAA, was part of the Consolidated Appropriations Act, or the CAA, and it restarted the Payroll Protection Program. The new legislation has made some changes to address what people considered weaknesses in the prior legislation. Specifically, it has made some changes around minority, underserved, veteran, and women-owned businesses. So the legislation refunded the PPP program with approximately $284 billion. Of that, they have specifically set aside $15 billion for community financial institutions with less than $1 billion in assets. The reason for this is they thought that it is these smaller community financial institutions that are the ones that are helping the smaller, underserved, disadvantaged businesses. They also set aside $15 billion for lending by insured depository institutions, credit unions, farm credit, and farm credit institutions with assets less than $10 billion. Again, these are specifically to try to help the smaller businesses and the sole proprietors and partnerships that a lot of people criticized the first round of PPP legislation for. Next, $35 billion was set aside for new first draw PPP loans. And we'll get into the difference between first draw and second draw in a few minutes. And finally, 15 and 25 billion were set aside for first draw and second draw loans, respectively, for borrowers with a maximum of 10 employees or for loans less than $250,000 in low or moderate income neighborhoods. So I think this time they really did take some actions to address some of the underserved businesses that really struggled to get loans in the first round. So the legislation and guidance changed some of the terminology around. So now there are first draw loans and second draw loans. First draw loans are loans that were done before December 27th, 2020. Those are all first draw loans. Or after December 27th, 2020, but it is somebody's first time getting a PPP loan. A second draw loan is somebody that already has a first draw PPP loan, regardless of the date of application or disbursement of your first draw PPP loan. The application has been extended for both first draw and second draw loans. The applications now will be accepted until March 31st, 2021, or until funds are exhausted. The covered periods have been extended from December 31st, 2020 to March 31st, 2021. However, I do have to qualify that somewhat because that is the wording that is in some of the guidance. But last Friday, new rules and regulations came out. It's what's called a CFAR, Codification of Federal Regulations, that went into lots of detail on forgiveness. And they are very clear in that if your first draw loan was before December 27th, 2020, that your period for the FTE and the salary tests is still December 30th, 2020. It does not change. It does not change the periods for those tests for full forgiveness. One of the really significant changes is that tax deductions are now allowed for expenses paid with proceeds of a PPP loan. Originally, when the first round was done, Congress's intention was that you got forgiveness and you still got to deduct the expenses. The IRS came out and said, whoa, wait a minute, that's not in the law. That's double dipping. You can't do that. Well, they fixed that with legislation now. So you still get to deduct those expenses on your tax return. The US and Treasury and the SBA have issued additional interim final rules. And I fully expect more. So on January 6th was the first round of interim final rules. Like I said, another one came out last Friday. The other one is more around forgiveness as opposed to an overview of the entire program, including the application. The IFRs get extremely complicated. There are so many IFRs, interim final rules, that have been issued on the PPP program that it can get very confusing digging through all of them. There are now new applications for both first draw and second draw loans, okay? So if you are doing a first draw PPP loan, make sure you use the new application that was issued on January 8th, not one of the previous applications. Also, this is the first time that we have seen the second draw application. And, the second draw application, there have been some criticisms about it because they have changed some terminology around for sole proprietors, social security numbers versus FEINs. And it's caused some confusion. In fact, some of the confusion was part of the reason that the AICPA wrote a letter to the SBA about some issues with the automatic system that the SBA is using for applications. New FAQs were issued on January 29th, 2021. So there's now 56 FAQs. They added 3 new FAQs, 54, 55, and 56. But at the same time, they disclaimed FAQs 51 through 53 because they have been not updated for the EAA. They say they are working on updating them. I checked this morning, nothing new has come out. Friday evenings is always a good time to check because that seems to be when the SBA likes to release things. As of February 7th, approximately $101 billion in PPP loans have been approved. So there is still lots of money out there, approximately $184 billion is still sitting out there and available for PPP loans. So first draw application, a lot of the rules are the same as before, can have no more than 500 employees. The same affiliation rules, okay? So this is the affiliation rules that can be found on the SBA's website to determine affiliated entities. It is still based on 2.5 times average monthly payroll, okay? So, one of the key documents is a 941, and everything should tie back to that 941, those 941s, except for your limiting compensation at $100,000 on an annualized basis for anybody, or $35,000 for anybody that makes over $100,000. You are allowed to use 2019 payroll, 2020 payroll, or the precise 1-year period before the expected date of disbursement. I don't think many people are going to use that last option because it doesn't coincide with, payroll reporting dates and things like that. It's much easier to use 2019 or 2020. You can use whichever payroll is higher. There's no limitations on that. They have added 501. Oh, I should mention one thing because I have had this question, is that you do not have to remove people that have left from your payroll calculation, that have left your company. If they were paid payroll, they are included in the average calculation, obviously only for the period where they worked for your company. 501c6 organizations are now eligible organizations for both first draw and second draw loans. Destination marketing organizations are also eligible with some limitations regarding lobbying activities. So when they're talking about destination marketing organizations, they're talking about, say, it's an organization and you do marketing to get people to come to Port Aransas. Okay, that's a destination marketing organization. A lot of times they have some sort of government affiliation. That government affiliation does not make you ineligible. Lobbying activities can make you ineligible. And as before, you must have been in operation on February 15th, 2020. Public companies are not eligible this time around. Permanently closed businesses are not eligible, but temporarily closed businesses are eligible. So that's something to keep in mind. If you're in a position where you're struggling and you just need a little, you just need some funding to help you get through these difficult times. Businesses in bankruptcy proceedings, so a debtor in a bankruptcy proceeding, are not eligible, but there are a few exceptions, one of which is, you go to the judge and you get the judge to sign off on it. There's some exceptions around that. Another big change is amounts of EIDL loans made between 1/1/2020 and 4/3/2020 can be added to the loan amount. So you do your average payroll calculation, and then you add in the amount of the EIDL. Seasonal employers, the same rules still apply. Any 12-week period between 12/15/2019 and 12/15/2020. And there are certain instances where if you had a loan, the PPP loan, dispersed before or approved before December 27th, 2020, you may be able to get an increase in that loan. One example is if you're a sole proprietor with employees and you didn't put your compensation in there, you can now go back, add that in, and go back to your lender. Also, seasonal employees. If you did the calculation back in May and you get a higher number doing it now, you can go back to your lender and say, hey, I recalculated my payroll and I should have been eligible for a larger loan amount. Okay, second draw PP loans are generally subject to the same requirements as first draw PPP loans. The SBA kind of likes to say subject to the same conditions as previous, except where they're not. 300 or fewer employees this time for second draw. Again, public companies are not eligible. And a very important point, a borrower must have had a first draw PPP loan and used the full amount on or before the expected date of disbursement of the second draw loan. It does not mean you have to have been forgiven. It does not mean you have to be in the process of being forgiven. You just have to have used the full amount of your first draw PPP loan, and the full amount must have been used on eligible expenses. Remember, 60% needs to be on payroll. Again, permanently closed businesses are prohibited. However, temporarily closed businesses are eligible. So to get a second draw PPP loan, this was really aimed at the hardest hit of businesses out there. So you must have experienced a 25% or greater reduction in revenue in 2020 compared to 2019. Now, what do they mean by that? It's a reduction in gross receipts in one quarter in 2020 compared to a corresponding quarter in 2019, or a reduction in annual gross receipts in 2020 compared to 2019. So the SBA has come out with new guidance on how you actually do this calculation and what is included in gross receipts. It is generally the definition that is used in the SBA CFARs regarding what qualifies different businesses as a small business under SBA. So generally, gross receipts include all revenue in whatever form received or accrued, very important, or accrued in accordance with the accounting entities. Okay, you cannot change accounting methods from 2019 to 2020 to try to create this reduction. You need to be consistent, okay, from whatever source, including the sale of products, interest, dividends, rents, royalties, fees, commissions, all reduced for returns and allowances, but excluding any capital gains or capital losses. The gross receipts terms are in general the same terms used on the IRS tax forms. Gross receipts explicitly do not include the following: taxes collected for and remitted to a taxing authority, for example, sales tax; proceeds from a transaction between a concern and its domestic and foreign affiliates. Again, this will get back to the affiliate rules under the SBA CFARs. For nonprofit organizations, veteran organizations, nonprofit news organizations, eligible 501c6s, destination marketing organizations, gross receipt has the same meaning as it does in section 6033 of the Internal Revenue Service Code of 1986, which is basically gross amount received by the organization in its annual accounting period from all sources without reduction for costs or expenses. Now, what documentation do you need to have to satisfy this reduction requirement? Quarterly financial statements of the entity. If the quarterly financial statements are not audited The applicant must sign and date the first page and initial every subsequent page. Quarterly or monthly bank statements showing deposits. And you have to show which deposits are part of gross receipts, or an annual IRS tax filing. So if your loan is greater than $150,000, documentation is required to substantiate the reduction at the time of application. If your loan is less than $150,000 or less, documentation is not required at the time that the application is submitted, but it is required at the time you submit your application for loan forgiveness. The maximum loan amount is 2.5 times monthly payroll costs, or $2 million. Now, for second draw loans, they have said entities beginning with NAICS codes, beginning with 72, which is basically the accommodation and food service sectors, some of our hardest hit businesses, they are allowed up to 3.5 times of average monthly payroll. NAICS codes can be very important for a lot of different reasons. Refinancing of EIDL loans does not apply to second draw loans. The requirements to document the amount of a second draw loan is essentially the same as the first draw loan. However, if you're using your 2019 payroll and you are using the same lender that you used for your first draw loan, there is no need to submit additional documentation because the lender already has your calculations and your support from your first draw PPP loan. At least that's the SBA's assumption. Forgiveness rules are the same for first draw and second draw PPP loans. You know, the one exception I'll make to that is what I had mentioned before, is if your loan date is prior to December 27th, 2020, your period for FTE recovery and wage recovery to get full forgiveness is the end of your covered period, or December 31st, 2020. If your loan is dated after December 27th, then your date is the end of your covered period, okay? Forgiveness rules from the CARES Act still apply, except as I mentioned before, where they're modified by the EAA. There is now a simplified loan forgiveness application for loans under 150,000. Before there was a simplified application, it was S application for loans under $50,000. They've now made it $150,000. It's literally a one-page application, super easy to fill out. The covered period now begins on the date of disbursement and ends on any date selected by the borrower that is between 8 and 24 weeks from the disbursement date. Before, the language was sort of 8 or 24 weeks. Now the language is any date between 8 and 24 weeks. So loan forgiveness is refinancing of an SBA EIDL made between January 31st and April 3rd is now a forgivable expense. If you have already filed your application for forgiveness and you had to take out your EIDL, go back to your lender. You can now get that money back, okay? Before it was a reduction in forgiveness, not anymore. Also, we've added some new eligible expenses, covered operations expenses. So this is items such as accounting systems, HR systems, SaaS solutions things that you use to operate your business. Property damage costs related to the unrest that occurred during 2020 and was not covered by insurance or was not recovered through some other means. Supplier costs. So supplier costs means if you had a contract or a PO in place prior to your date of disbursement, then those costs, because you had already committed and you weren't able to change it, those costs are now covered costs. Okay. But it has to be before that loan disbursement date. Unless you're in, say, food and beverage, where you have perishable supplies. So perishable supplies are covered regardless of whether the PO was in place before the disbursement date. And there's a lot more detail in all of these. Covered worker protection expenditures. So now a lot of the expenditures for PPE, plexiglass shields, hand sanitizer stations, all of those things that you were required to do by a federal, state, or local regulatory agency, you now can use those as a covered expenditure. So before we go to questions, there are a couple other things I would like to mention. If you happen to be a government contractor, okay, so you do business, for example, with the Department of Defense, and you charge direct labor to that contract, you cannot use those dollars that the DoD is paying you for as part of your forgiveness application. Also, if you're getting a tax credit, you cannot use that portion of any DoD reimbursed costs. Anything that is covered by a government contract that you are being reimbursed for, DoD, DOE, DOL, that would be considered double dipping under the FARs, the Federal Acquisition Regulations. So if you're an entity contracting with the government, be very careful with that forgiveness application. Also, for those of you that are government contractors, there is a section of the FARs, section 3610, which is an additional source of funding and paying for time off during the coronavirus. So it might be something to look at. Again, section 3610. Last thing is I mentioned the AICPA letter to the SBA, and that, the AICPA had a lot of criticisms of the changes that the SBA has made to their electronic system. So, some of those criticisms were changes from social security numbers to FEINs, that the SBA is rejecting loans without giving an explanation. If your loan gets rejected or your loan gets reduced, go and speak to your lender about it, and try to have your lender help you figure out why, or we can help you try to figure out why, because a lot of times it's just a hiccup in their system, or they've been cutting back loans because people included salaries over $100,000, so they're capping them at $35,000. They're reducing the loan amount, but they aren't telling you why the loan amount is being reduced. Also, the processing time is significantly longer than it was on the first round of PPP. There were a lot of PPP loans to entities that were on the government do not do business with list. So this time the SBA is taking a lot more time reviewing loans. So don't expect the quick turnaround. Also remember, you're still having to sign the same reps and warranties for first draw loans, second draw loans, forgiveness applications, and the SBA and the DOJ don't take this lightly. As of the end of December, there were 90 individuals that had criminal charges filed against them as a result of PPP loans. Don't let that scare you. Just make sure, document, economic necessity, and make sure that you do your calculations correctly. Okay, so I think, Chris, now we're going to open it up for questions.
Yeah, thanks for that presentation. We do have one question in the Q&A already. And again, if you have a question, go ahead and put it in the Q&A and we'll, depending on the number of questions, either answer it live on the presentation, or if we can't get to it or don't have the answer, we'll follow up with a summary of the questions in an email. So the first question regards affiliation rules and do they apply to ERC? For those of you who, just a little background, for those of you who have applied for PPP loans, really the PPP, there's only size limits, but if you've ever applied for SBA loans, you know there's some pretty stringent affiliation rules. There are similar rules in place for the ERC in terms of including affiliates in your employee account, but they're not the same rules as govern SBA. The rules are determined by the Internal Revenue Code. We'd have to look on a case-by-case basis how they would apply to a specific entity. I don't think they are quite as broad as SBA affiliation rules, and I think regard more in terms of affiliation and relatedness among companies for tax purposes.
Thanks, Chris. So at the moment, since we don't have any questions, I thought I would bring up one other topic that wasn't in our presentation, and that is important, especially here in the Austin area, is the shuttered venues grants, and just a quick status on where we are with that. So for the shuttered venues grants that are under the CAA, there is not an application yet. The SBA is working on the application. They have not given a timeline as to when the application will be available. There will be grants of up to $10 million available. However, the SBA has published an FAQ that came out last Friday. So in that FAQ, they answer some of the questions around the shuttered venues grants, but I'll warn you, in that FAQs, there's a lot of places they say maybe, or we think so, and you'll find out when the application comes up. So we didn't want to go into too many details on that because there are so many unknowns on that program at the moment. So we have one question, and that's, will today's presentation be available to participants after the meeting? Yes, we will make the presentation available. We usually do that. We also have a PPP landing page, links to lots of resources on the vcfo website. And that's where you can generally find presentations and things like that.
We did have another question come up in the chat regarding sole proprietors and how they should proceed since they don't have payroll and instead are putting money back into the business. If you're referring to the ERC, sole proprietors are not eligible for the employee retention credit, but they would be eligible for PPP. And Jennifer, maybe you can comment on how that is handled with regard to the loan size.
Yeah, so sole proprietors, partnerships, corporations, all eligible for PPP. Sole proprietors, there have been some struggles with sole proprietors, and the SBA and the legislation really didn't address some of those struggles. The calculation for a sole proprietor is based on your IRS Schedule C. Where the issue has come in is when you look at Schedule Cs for a lot of sole proprietors, there is a minimal amount on the Schedule C because sole proprietors are trying to limit their tax burden. But there have been stories. There was an article in the New York Times about sole proprietors getting $10 and $20 PPP loans because it was based on, 2.5 months average of Schedule C.
Yeah, it's a double-edged sword of income minimization for sole proprietors.
Yeah, yes, it is. And I have personal friends that are struggling with that issue. It's like, here I was trying to minimize my tax liability, and now it's hurting me because I can't get a significant PPP loan, even though in 2020 I haven't had much business.
So I'd like to mention one other aspect that was changed that may affect some of our clients and attendees today. For those, I know a lot of small businesses have taken advantage of traditional 7A and 504 SBA loans. And if you did have such a loan in 2020, you may recall that as part of the initial CARES Act legislation, the federal government picked up principal and interest on those loans for a 6-month period. And and everybody should have gotten that automatically. That was renewed as part of the legislation in December 27th legislation. In fact, if you have an SBA loan, you may have already received a letter from the SBA. They are going to pick up another 3 months of your principal and interest payments. And if you fall within certain NAICS codes, specifically those related to hospitality, accommodation, some retail businesses, home health care, things of that nature that were more severely impacted than others, they will pick up a total of 8 months of principal and interest payments for SBA loans, not PPP loans, but SBA loans. They do cap the payments at $9,000 per month now, but like last time, those payments are not considered taxable income, and you don't need to do anything to get it. The bank that is managing your SBA loan should automatically apply it. So that is additional relief that you have to look forward to. It's also worth noting that if you apply for a traditional SBA loan during this time period and receive it, they will make the first 6 months payment. So if you're fortunate enough to be in a position where you're looking to expand your business and feel that an SBA loan might be a good option for you, now's a good time to do it, because you will get 6 months of principal and interest paid for on that new loan. So I see another question that has come in asking about 501c3s being ineligible for PPP loans. And I believe they are eligible. Is that not the case, Jennifer?
I am checking that right now. The only new one that they added was 501c6. Well, let us get back to you on that one, because I don't want to sit here and say, yes, they definitely are eligible, without actually going and looking in the guidance to see specifically that they are eligible.
There are certain nonprofits that are eligible. We'll just verify we're getting the right section of the code that applies to the 501c3.
501c3s are eligible.
Okay, I thought they were.
I just like to verify.
All right. Well, it looks like that might be all of the questions for now. So I'd like to thank everybody for joining us today. We really appreciate it. If you have follow-up questions, feel free to reach out to us. Again, the presentation will be posted on the VCFO website, and I'm sure a link will go out to the participants, as well as a summary of all the questions that were answered here today.
Yeah,
thank you so much, and hope you guys have a great day.
So thank you, everybody. And please do reach out, especially if you're a government contractor. DoD contracting happens to be one of my specialties, and forgiveness gets really complicated in that industry because it's not just direct rates, it's indirect rates. So we would love to help.
Thanks.